Welcome to Casual Friday at Automation Finance. I'll just give people a moment or two to join, and we'll start off with a few pages of PowerPoint, which is probably the quickest way to explain what it is exactly that we do here, and then I'll answer any questions that you may have. So why don't we just start? So let me just start now with the presentation. I'll just find it here on my computer somewhere. That should be it. Hopefully you can see what I can see. So my name is Paul Burkett. I'm the CEO of Automation Finance. And we started this business in late 2013. And just at the end of 2019, we got qualified by the SEC. Now, qualified does not mean we're endorsed by the SEC. It just means we're registered with them and they have no objection to what we're doing. And what we're doing is soliciting investment directly from the public under Regulation A of the 1940 Act here in the US, which allows us to raise investor funds to invest in our business, which is the purchase and rehabilitation of non-performing mortgage debt. So we buy loans where we buy loans on houses where the borrower is not paying, and our job is to convert those loans from non-performing to re-performing, and hence the name of the fund. We're currently managing approximately $200 million. The amount of under management changes because, as you can imagine, people pay off their loan, we buy new loans, and that can change the amount of assets under management. But typically, we have about 2,000 loans at any one time. And our historical returns on our first three funds have been about 21%. You can read all of this detail in our SEC filing, which there's a link at the end of this video, and you can go through all of that. And if you have any questions on our financials, our historical performance, or really on anything at all, reach out to Investor Relations or to me. My email will be at the end, and I'm happy to answer those. Our plan is to raise $50 million in 2020. Under Regulation A plus of the SEC code, and I'll just talk you through a little bit about the business and how it works. So first thing, I guess, is because we're SEC regulated, there's very strict rules on what I can say and what I can't say. So the key thing is really this: the fact that we've been very successful in the past is no guide to how we may perform in the future. So our historical performance is interesting, but it's not a guarantee. There are no guarantees. This is an investment. There are no safe investments. Even holding cash is not necessarily safe because of inflation. So just be aware of that. Make sure that you read the prospectus in its entirety. I know it's 80 or 90 pages, but please do read it so that you understand the risks. But also it explains in great detail precisely and exactly what we do every day and how we do it. And you'll need to satisfy yourself that we are competent to manage your money in this regard. The key highlights of the fund. So what is this fund? It is an LLC. It's a fund in which our investors get paid first. And it's unique in the way it's structured in that we are selling preference shares to the public. And those preference share means you get paid first. And you also get your 8% return first. So money that comes in once the auditor has been paid and the bank fees have been paid and those kind of fees that you must pay to run a business, any cash from operations goes to pay the investor their preferred return of 8% and then to return their capital. So Automation Finance does not make any profits until the investors have been paid. It's an asset-based investment. So we don't buy houses, we buy mortgages secured by houses. And typically when we're buying a first position lien, we'll be paying approximately 60% of a price for that loan that equates to 60% of the value of the house. So if the house is worth $100,000 and the mortgage may have a balance of any amount, it may even be in negative equity. So the house might be worth 100, but there might be 150 or 200,000 of mortgage debt on it, we'll pay 60% of the value of the house. So there's always quite a big cushion of equity for the investor between what's paid for the loan and what the house is worth. So we'll pay about 60% loan to value on first liens and up to 30% loan to value on second liens. That's just typically historically what we've done. And we make monthly distributions, which means the cash is paid out to you each month, either in cash. Some people, to their IRA, for example, they want a monthly distribution, we'll just pay it out in cash. But you can also choose to reinvest the dividend, and so you're compounding the interest that you're earning on that. About half our investors choose to take a distribution, about half our investors ask us to reinvest that in the fund. So over the term, they'll make significantly more, assuming everything works out as we plan that it will. We also offer best efforts liquidity. So every investment entity like ours must have a term. Our term is 5 years. But we understand that some investors don't want to stay invested for 5 years. They may want to leave after a year or 18 months or sometime less than 6 months or then 5 years. So we offer best efforts liquidity. So what does that mean? That means, let's say you invested $10,000 in year one, and halfway through year two, you say, you know what, I need to get that cash back for some unforeseen circumstances or for whatever reason. Best efforts liquidity means that we will do our best to acquire those assets back from you. So in practice, that means the next $10,000 that the fund, AF Reperfroance Fund 4, raises will be used to repurchase your units. So we as a company will repurchase your units and we can then sell them to somebody else. I should point out that if you withdraw in the first 6 months, there is a penalty, and in fact, you lose 2 percentage points of your 8% in the first 6 months. And if between month 6 and month 12, if you withdraw, you lose just 1 percentage point. So if you leave before the end of the first year, you are losing some of the target interest that we would hope to pay. So you should really plan. These are long-term investments. These are not highly liquid. The units are of a fixed price, so the share price does not go up and down. I get regularly asked, is this a REIT? It's not a REIT in that a REIT is a traded instrument where the stock price can go up and down. Our stock price doesn't change. You're simply subscribing for preference shares at an 8% return. That is it. So that's how that works. And the payments are made every month. There are no investment fees. We get asked about fees all the time. We pay fees to the bank. We pay legal fees. We pay fees to the loan servicer, but the investor does not pay us any fees. So if you compare, for example, maybe a broker who might sell you an investment product, there will be up to a 1% or maybe higher fee each year. So over 30 years, you'll pay 1% each year on the funds that you've invested. So you pay about 30% of the total amount that you invest in fees. We charge no such fees. 100% of the capital that you invest is invested in the entity which generates a return. We do not charge any fees. That's not the same as saying that there are no fees. There are fees that we pay, but they're not charged to the investor. So I hope that's clear. It's open to everybody, and it's a $250 minimum. We don't get too many people investing $250, but the idea is we want to make it available to the most amount of people. So that's why it's such a low minimum. Historically, and again, historically is no guide to the future, but we've generated about 21.5% on the previous portfolios. And the way we do it is by helping people avoid foreclosure. So we're buying a loan secured on a house, a mortgage, where the borrower is not paying. And our job is to convert that loan from non-paying back to paying. And the reason we can do that is because we've built up the skills over 6 or 7 years of being able to do that at scale. So far, we've processed around 2,000 loans. So we do it quite a lot, and we've built the skill set required to be able to do it at scale. And I'll just remind you again that there are no safe investments. Even the purchasing power of cash can be eroded by inflation. And I want you to make sure that you read the entire offering memo on our website or the SEC website And there's a link at the end of this video that you'll be able to click on and read that. So I do encourage you to do so. Just to get into a little bit more detail, I'll give you an overview of the fund. We're 5-6 years old now, since it's 2020. I need to update this slide. We're managing around 2,000 mortgages. Our objective is to work with borrowers who've fallen into arrears. We work with them to help them keep them in their homes. Typically, we'll buy a pool of loans for, let's say, $10 million. We'll convert between 2 and 5% of that portfolio from non-performing to performing each month. And then have most of our basis, so the cost of that investment, extracted by about month 18. And we're currently raising $50 million under Regulation A of the SEC code. You're probably on this webinar because you've seen one of our ads, or you've heard me speak at a conference or interviewed on a podcast. So welcome to take your questions at the end. I have a few more pages and then we'll open it up for questions. What are the key features of the fund? We target a return of 8%. There is no guarantee. It is simply what our intention is. So far, we've paid 8%. We've never lost a penny of capital. We've never missed or been late with a payment. And we offer best efforts liquidity, which means if you need to leave or if you wish to leave, we will work with you to do that. We're buying non-performing residential mortgages and we're modifying them to make sure that the payment is affordable to the borrower. And historically, which is no guide to the future, we've generated 21.5% return for our investors. And so how does the business actually work? So here we have a home and we're buying this mortgage at about 40% discount to the home value. So in this case that I'm worked through here, the value of the house is $110,000. There is a $100,000 mortgage on it. So we've bought it for $60,000. So the difference between the $100,000 balance and the $60,000 we paid is about $40,000. Well, it's not about, it's exactly $40,000. And our business is sharing that $40,000 with the borrower. So we have a proprietary system called clockworkAM that we've built over 5 or 6 years. In our team, there's around 30 people in the team. Approximately 10 of those people are technology people. So they're building out our tech platform to ensure that we can manage these loans in an efficient manner and at scale to help the borrower get back on track. And so we'll work with the borrower to get them back on track. And then once the loan is reperforming again, in other words, the borrower who was not paying is now paying again, we can use that payment to pay our investors, or we can sell that loan because now it's performing again, and we'll probably sell it for 80 cents on the dollar. So if we bought it for 60 and we sell it for 80, in this case, that would be a $20,000 profit. And we can use that $20,000 profit to pay interest payments to our investors, or buy another loan, or just keep it in reserves. So long as we're making our 8% per month, everyone gets what they're supposed to get. We have a lot of experience. I've just picked two people, myself and Kwang. I've 18 years at PepsiCo, and before that, 4 years at Procter & Gamble. But all the time, a real estate investor. I've owned 70 or 80 houses across the world. And I've actually sold almost all of them now and put all of that cash into this business. And Kwang joined me from Goldman Sachs. He's been in this business for 20 years. He was a bond rating specialist. He worked at JP Morgan and is an expert on everything relating to the mortgage industry. And we also have about 28 others, attorneys, paralegals, bankruptcy specialists, a team of about 10 working on the technology, and loan servicing people who are responsible for dealing with the borrowers. So that's a licensed separate business that works with the borrowers to get them back on track. Again, our past performance, if you look just simply on an IRR basis, what's our internal rate of return? It's averaged at about 17% without any leverage. And our current pool is on target to deliver about 22%. That's the latest projection at just the end of last year. So out of that, approximately half would go to the investor if we're making 17 or so and the investor is getting 8. And we use the other 7 or 8% to run the business, because we have to pay salaries and all of the things involved with running a business. And again, these historical numbers are no guide to the future. Who knows what the future holds? So how do we do it? The key part is really getting in contact with the borrower. We're relentless about helping people, because typically when a borrower, is behind on their mortgage, they expect they're going to get foreclosed and lose their house. So it can be quite hard to convince them that actually we don't want their house. Sometimes a borrower will not deal with us. They just ignore us. They won't talk to us. And then we have to proceed with foreclosure and eventually sell the house. That's not good business, in that the returns from selling a house like that are lower than they would be if we were to get the borrower to reperform. So it actually makes better business sense to keep people in their homes than it does to get the property and sell it. And we have a very strict calendar. We work assiduously with every borrower to ensure that they can't say they didn't hear about us, they don't know who we are or what we're trying to do. And we work very systematically for the first 90 days to get those borrowers. We even send a licensed inspection agent out to each home to make sure that it's being preserved, because we're buying nationwide. And so we need to make sure that the properties, if they're vacant, are being maintained. And often you'll find that someone goes out to knock on a door to see if the house is occupied or not. The borrower is actually there. And that can be the start of a conversation with them, which ultimately will lead to them keeping their home. And what is the secret sauce to getting a borrower who is not paying you to suddenly start paying you? Well, the key thing is the basic economics. If they're living in a house where the rent would be, let's say if they were renting that house $1,000 a month, if we can make their mortgage payment $800 or $900 a month, there's a big incentive for them to start paying again. The way we'll do that is by extending the term of the loan, or reducing their interest rate, or forgiving some part of the loan. Because we're not a bank, we're not restricted by any of the rules that the banks are restricted by. We're allowed to write off payments. That's no problem. If, let's say, Citibank was to start writing off payments for borrowers, that would be a big problem, because all of their other borrowers would stop paying, because they heard in the church group or at the tennis club or wherever they heard, meet with their friends, that, oh, Citigroup, if you stop paying them for a while, they'll forgive some of your mortgage. So we can do something that others cannot do. We have two sources of competitive advantage. If you look on the left side, we're basically buying investment grade products at about 60% of their asset value. So once that loan has stopped paying, investors don't want to own those loans. It's only specialist shops like ours. And we're in the business of really riding that curve down to 60% and then riding it back up again once they start paying again. And we consolidate the big gap that currently exists between the investor and the borrower. So currently there are 6 layers. The investor hires a loan servicer. The loan servicer has a servicing manager. Beneath the servicing manager, there are multiple other people. There'll be a third-party call center often. There'll be local vendors, and there'll be a local law firm. Before you get to the borrower, we consolidate all of those things on a single platform called clockworkAM. So everything to do with loan servicing is done on the platform. Everything to do with legal recovery is done on the platform. Everything to do with document management is done on the platform. Property preservation if the home is empty, and all of the accounting. So we control our destiny by controlling the platform that manages all of the loans. And this is what the 30 people I mentioned in our tech group has been building for the last 5 or 6 years. And it's a key source of our competitive advantage. It allows us to control our costs and get our results more quickly and pay our target of 8% return. We've been modifying loans at about 4 times the industry average. FHFA is the regulator for Freddie Mac and Fannie Mae, the 2 government-sponsored entities that issue most of the mortgages. And I just put some quotes here from Josh. He works at our loan servicer, from our monthly survey, and I won't read them all out, but you can get the idea. We ask 5 questions of every borrower once their loan modification is complete. Remember, these people haven't made a payment in 5 years. So we ask them, how satisfied are you? And they say 90% of them say they're either quite satisfied or very satisfied. And the other question, important question, is does your modification work for you? And 91% of them say that the modification does work for them. So we then collect their payments via ACH, so it's auto drafted from their bank account on payday, and 90-something% of them keep paying. Some of them, of course, do fall off the wagon, and we need to get back in contact with them again, but we've a more than 95% success rate with these loans. I'll walk you through a couple of examples. In this case, it's a house in Slidell, Louisiana. We bought it for $137,000. The house is worth $225,000. So we paid exactly 60 cents on the dollar for that. And it took us about 18 months to get the borrower to start paying again. It was an interesting story, this particular one. It was parents with basically the whole family living in the home, but the sons were not paying any rent, but they were using light, heat, electricity, cable TV, cell phone plans. And actually our intervention helped, I guess, a bit of a wake-up call that, you know, there's no free ride. And they then agreed that they would make some payment towards the second lien. In fact, this was actually a second lien that we owned on this house, and some of the taxes. So we ended up making about 32% overall on that, of an IRR of 19.5. Again, that may not be the case for every loan. Some loans we only make 7 or 8%, some we make 30%, but that's just the nature, one example. Another example, in Mastic Beach in New York, this house, you get a lot of house in upstate New York for $143,000. We bought it for just under $80,000. And this was another one that we got reperforming. The borrower had a lot of medical bills and had declared bankruptcy. And there were a lot of arrearages of tax and sewer and municipal fines. The property had not been maintained and it had been fined by the local municipality. And we ended up having to clear those as about $15,000 that the borrower couldn't afford to pay. But we did very well on that one, made a return of about 40% on that. But we held it a bit longer, almost just over 2 years, and made 19% return on an IRR basis. So, I mean, these are good examples. I think next time I'll do this, I'll do some bad examples, but it typically, you know, mid-teens is what we've done on a couple of thousand loans, but that may not be always the case going forward. So that's really it. That's the overview of the business. Just to take you through again some of the key parts of it. We pay an 8% preferred return. We're buying mortgages secured on properties at 60% loan to value. On first liens and on second liens, about 30%. We make monthly distributions, which means your 8%, every month will pay you 1/12 of 8% multiplied by the capital that you invested, assuming everything goes as we think it will. And that can be paid by check or by ACH, direct into your bank account, or it can be reinvested in the fund. We offer best efforts liquidity, but there is a penalty if you withdraw before the first anniversary of 1 percentage point of interest. So you would have in fact only gotten 7%, not 8% if you withdraw in the first year. And it's open to everyone. We don't charge any investment fees. And as I said, we've had an average return of 21.5% across all the portfolios, but that may not be the case going forward. And we're doing so by helping people avoid foreclosure. There are other funds like ours, but their job, what they choose to do is to foreclose, rehab the house, and sell them. You see a lot of those kind of homes on the TV shows, Fix and Flip House, and the TV shows like that. So that's really all I'm going to talk about on the PowerPoint. And now I'm going to take some questions. I should also say there are no safe investments. Even holding cash can be eroded by inflation. And please make sure to read our entire offering memo on our website and on the SEC website before considering making an investment. I'll stop on the PowerPoint now, and I'll take any questions that people may have. Jeremy, you might help me here because I'm not sure if, it's unmute. If I just press unmute, can people hear me, or what do I do?
You're trying to unmute.
So people can speak to me if they have questions. I've got 7 people with questions. Okay, great.
Go ahead.
So the first question, am I able to have earnings set to automatically reinvest? Yes, sorry, I've covered that one already. Yes, so you can reinvest your monthly dividends. If you don't want the cash paid to you, you can reinvest them. How much are the monthly dividends? Is it a 5-year term? It is a 5-year term. All funds have to have a term. All funds like ours have to have a term. So at the end of 5 years, assuming everything goes according to plan, all capital and all interest will be repaid. We may end the fund early and repay early, and we do offer best efforts liquidity, but it doesn't mean that we'll definitely go the full 5 years. At the end of 5 years, we will close out this fund, so it is a closed-ended fund, typical to any other fund. What percent of capital is paid in dividends? From Robert. What percent of capital is paid in dividends? Well, no capital is paid in dividends. The capital is all invested in non-performing loans. We don't use capital to make payments. We pay 8% interest, a target of 8% interest on all funds that are invested in Automation Finance Reperformance Fund 4, but we don't use that capital to make payments back to our investors. That's not how it works. The payments are made from the profits from getting the loans reperforming. So those payments will come either as a result of us buying a loan for 60 and selling it for 80, or as a result of a borrower making a payment. So often because we're buying it at a discount, the payments from borrowers as a percentage of the purchase price of the loan is more than enough to cover the 8% based on our historical experience. Ryan asks, how does the company make money if no fees? Well, we're soliciting directly to the public for capital to buy these loans. We're not an investment operator. We are a business operator. So the company makes money by buying the loans with the capital that we raise and then selling them at a profit. The first 8% goes to the investor, and the rest Automation Finance keeps as a profit. So that's how we make money. What are the requirements for a new account? From Myra. Myra, the requirements for a new account, well, if you go to the website and click on Invest Now, I strongly suggest you read the circular first. You should do that. You should also watch the video. I did a video that's about 5 minutes long that explains in detail what we do. And also click on some of the videos on the website where borrowers who we've helped tell their story. And I think once you've done those 3 things, you'll understand the business as well as you would need to make an informed investment decision. And then follow the online steps. You can call Investor Relations. I know Chris is up there right now, and talk to them about opening the account. But it's a bit like opening a eBay account or an Amazon account. It's pretty straightforward. There is a short delay of a few days because we've got to do know your client and anti-money laundering checks that's required by the SEC. And it's good business practice because we want to make sure that our investors are legitimate. And it's as simple as that. And you then get a username and a log on. You can log on every month and see how your account is doing and see your dividends have been paid. The dividends get paid around the 26th or 27th of each month. And it takes 2 or 3 days for them to get from our account to your account. And that's really it. It's pretty straightforward. Any other questions? I don't think that these other questions are coming through there. They were coming on. If I click unmute, I think that might do it. No. Let's try this. Sorry, everybody. We've moved a different system. So, yeah, I don't really know. Maybe chat. I'll try chat, see if does that do anything. Oh, okay, so Drew, just want to clarify, you will pay 8% max to investors, correct? The higher numbers you talk about are simply highlight the fact there's plenty more. Yes, so Drew is asking, like, how does the money work? Let's say we made 17 or 18%. You're only getting 8. It's capped at 8. We use the other 7 or 8 or even 9 to pay all of our costs and hopefully to make a profit. So that's how that works. I think that was the last question. Sorry about the screw up with the questions, guys. But please feel free to send me a mail. If you go to www.automationfinance.com and click on the Invest Now button, it will take you through the process to invest. And if you have any questions at all, you can reach out to Investor Relations. They'll happily put us in touch. I'm happy to speak to people on the phone or email, whatever is most convenient for you. So thank you everyone for attending, and we look forward to working with you. Automationfinance.com is the website, and thanks for joining.